Most people believe markets react to bad news. They assume prices fall because something obvious went wrong. A headline, a policy decision, a shock everyone can see. That assumption feels intuitive. It's also incomplete. Markets don't primarily fear bad news. They fear what most participants haven't noticed yet. By the time a dramatic headline appears on your screen, prices have often already moved. Not because investors are emotional, but because positioning, liquidity, and expectations were already misaligned beneath the surface. The visible story comes later. The adjustment comes first. When a market has been trending smoothly for weeks, confidence builds quietly. Risk exposure increases gradually. Leverage accumulates where it feels safe. Nothing looks fragile until suddenly it is. That's why sharp moves often feel confusing in real time. They don't announce themselves politely. They don't wait for consensus. They occur when the market structure can no longer support the positions that have built up inside it. So instead of asking, what news caused this move? A more useful question is, where was the market vulnerable before the move even started? That's the lens we'll use here. Before opinions, before forecasts, before emotional reactions. We start by understanding what actually happened and why markets sometimes move hardest when nothing appears to be wrong on the surface. Let's step away from interpretation and focus strictly on what can be verified. On January 29, 2026, both gold and silver experienced a sharp decline after trading near recent highs. Gold had been trading close to $5,600 per ounce before falling to approximately $5,100, a move of roughly $500 within a short intraday window. During the same period, silver declined by about 10 to 12%, falling from levels near $120 to $121 to the low hundreds. What stands out is not only the size of the move, but the speed. The majority of the decline occurred within a compressed time frame rather than over several trading sessions. This indicates that selling pressure was concentrated and immediate, rather than gradual. Compared to the prior week, both metals had been trading at elevated levels, following a strong multi-week advance. Gold and silver had already delivered substantial gains leading into late January, and volatility had begun to increase even before the sharp sell-off. In other words, price behavior was already becoming less stable than it had been earlier in the trend. From a broader market perspective, this move coincided with rising macro uncertainty. In the final days of January, negotiations in Washington failed to produce a completed funding agreement, leading to a partial U.S. government shutdown beginning January 31, 2026. While this event did not occur at the exact moment of the price decline, it contributed to an environment of heightened caution across financial markets. It is also important to note what did not change during this period. There was no confirmed disruption to gold or silver supply. There were no announced changes to mining output, exchange rules, or physical market access. The underlying assets themselves remained the same before and after the move. In summary, the verified facts are straightforward. Both gold and silver fell sharply from recent highs on January 29, 2026. The decline was rapid and concentrated. It followed a period of strong upward momentum. It occurred amid rising macro and political uncertainty. These are the observable conditions. Interpretation comes next. To understand why this move matters, it helps to think in terms of mechanisms, not narratives. Market moves of this speed rarely come from a single decision or a single group of traders. They emerge from chain reactions that are already embedded in the market structure. The first link in that chain is positioning. After a prolonged advance, markets often accumulate one-sided exposure. As prices rise steadily, more participants become comfortable increasing risk. This can include futures positioning, options exposure, and various forms of leverage. None of this is inherently problematic until price begins to move the other way. Once prices start to fall quickly, the second link appears: forced adjustment. Some market participants are not choosing to sell, they are required to. Risk limits, margin requirements, and volatility thresholds are triggered automatically. This type of selling is mechanical rather than emotional, and it tends to cluster in short time windows. That leads to the third link: liquidity compression. When many sellers act at once and fewer buyers are willing to step in immediately, prices can gap lower. This effect is often more visible in silver than in gold, because silver generally trades with thinner liquidity and higher volatility. As a result, similar pressure can translate into larger percentage moves. Beyond the immediate price impact, these dynamics have broader implications. First, they reset the market's risk profile. A sharp decline reduces leverage, clears speculative excess, and forces participants to reassess position size and time horizon. This process can be disruptive in the short term, but it often determines how stable or unstable the next phase of trading will be. Second, they influence cross-market behavior. Precious metals do not trade in isolation. Movements in currencies, interest rates, and broader risk sentiment interact with metals pricing. When uncertainty rises, capital often moves quickly between asset classes, amplifying short-term volatility even if long-term fundamentals remain unchanged. Third, these events shape expectations, not just prices. After a rapid sell-off, investors become more sensitive to incoming data and policy signals. Markets may react more sharply to information that would have been ignored during calmer periods. What matters most is that none of this requires a dramatic external shock. Markets can move violently simply because existing structures are no longer aligned with prevailing prices. Understanding this cause and effect chain helps explain why the significance of a move like this extends beyond a single day. It's not just about where prices went, it's about how risk, liquidity, and behavior were reorganized in the process. History is most useful when it provides context, not conclusions. There have been multiple periods in past market cycles where precious metals experienced sharp, fast pullbacks after strong advances. In many of those cases, the setup looked familiar. Elevated prices, growing confidence, increasing leverage, and declining sensitivity to risk. What followed was not necessarily a change in the long-term narrative, but a sudden adjustment in positioning and liquidity. What matters most in these historical episodes is what happened before the outcome, not after it. Typically, the warning signs were subtle. Volatility began to increase even as prices rose. Intraday ranges widened. Reactions to routine data became more pronounced. These are signals of a market becoming less stable internally, even while headline prices still look strong. However, history also shows that similar price behavior can lead to different outcomes depending on the broader environment. In some cases, sharp sell-offs occurred within ongoing bull markets and were followed by periods of consolidation and renewed strength. In others, they marked the beginning of longer corrective phases where prices struggled to regain momentum for months. The difference was rarely visible in the first few days after the drop. It became clear only as macro conditions evolved. What makes the current episode distinct is the context surrounding it. Elevated price levels, heightened macro uncertainty, and a complex interaction between monetary policy expectations and risk sentiment create conditions that are not identical to prior cycles. Even if the market behavior looks similar on the surface, the underlying drivers are not the same in every detail. This is why historical comparison should be used carefully. It can help reduce emotional reactions by reminding us that sharp moves are not unprecedented, but it cannot be used as a shortcut to predict what must happen next. The correct takeaway from history is restraint. It tells us that volatility alone does not define trend direction, and that early reactions are often misleading. It also reminds us that markets typically need time, sometimes more than expected, to absorb large adjustments. In that sense, history's real value here is not reassurance or alarm, it is perspective. At this stage, the most professional way to think about the market is not in terms of predictions, but in terms of scenarios. Markets do not move in straight lines, and no single outcome is guaranteed. What matters is understanding what conditions would support each possible path. Bull case, strength resumes. In a bullish scenario, the recent decline functions primarily as a reset, not a reversal. For this outcome to develop, several conditions would need to hold. First, financial conditions would need to stabilize rather than tighten further. That does not require immediate optimism, but it does require that stress indicators, such as intraday volatility and liquidity gaps, begin to moderate. Prices do not need to surge. They simply need to stop forcing widespread risk reduction. Second, macro expectations would need to remain broadly supportive. This could include stable or declining real interest rates, reduced upward pressure on the US dollar, or clearer policy communication that lowers uncertainty. Under these conditions, precious metals can regain footing even if growth and inflation concerns remain unresolved. In this scenario, price behavior typically shifts from sharp directional moves to consolidation, followed by gradual strength. Participation tends to improve, and selling pressure becomes more selective rather than urgent. Importantly, this is not driven by enthusiasm, but by the absence of forced selling. Base case, consolidation and digestion. The base case is often the least exciting, but historically the most common. In this scenario, the market spends time digesting the recent move. Volatility remains elevated compared to earlier periods, but extremes gradually contract. Prices move within a range as participants reassess positioning, time horizons, and risk tolerance. Macro uncertainty persists, and incoming data continues to generate mixed signals. Rather than trending cleanly, the market responds in both directions, frustrating traders who expect immediate follow-through. This environment favors patience over precision. It allows excess leverage to be absorbed over time rather than flushed out in a single event. While it can feel unproductive, consolidation often plays a critical role in determining whether a longer-term trend can reassert itself. Bear case, trend deterioration. A bearish scenario emerges if the conditions that triggered the sell-off do not ease and instead intensify. This could occur if financial conditions tighten meaningfully, if the US dollar strengthens further, or if real interest rates continue to rise in a way that pressures non-yielding assets. In such an environment, rebounds tend to fail quickly, and risk appetite declines across asset classes. In this case, the market transitions from forced selling to active risk avoidance. Participants reduce exposure not because they are required to, but because the opportunity cost of holding positions increases. Over time, this can shift sentiment from uncertainty to skepticism. Importantly, this scenario does not require panic. It unfolds through persistent pressure, lower highs, and weaker participation. The defining feature is not one large drop, but an inability to sustain recoveries. Across all three scenarios, the key is conditional thinking. Rather than committing to a single narrative, the focus should remain on identifying which conditions are developing and adjusting risk exposure accordingly. Rather than reacting to headlines or short-term price moves, I focus on a small set of indicators that consistently explain why markets behave the way they do. These do not predict outcomes on their own, but they provide context for interpreting price action. First, the US dollar index, DXY. Precious metals are priced in US dollars, which means dollar strength or weakness can materially affect short-term pricing. I'm not looking for a simple inverse relationship, but for rate of change. Sharp moves in the dollar often coincide with liquidity shifts that can pressure metals, regardless of longer-term fundamentals. Second, Treasury yields, particularly real yields. Gold and silver are non-yielding assets. When real yields rise, the opportunity cost of holding metals increases. What matters most is not the absolute level, but how quickly expectations change. Sudden repricing in yields can create stress across multiple asset classes simultaneously. Third, inflation data and expectations. Reports such as CPI and PCE matter less for their headline numbers than for how markets interpret them. Are expectations for future policy shifting? Are investors revising assumptions about growth or inflation persistence? These second-order reactions often matter more than the data itself. Fourth, volume and liquidity conditions. I pay close attention to how price moves occur. Are declines accompanied by heavy volume and widening spreads, or by thin trading and gaps? Liquidity tells you whether moves are driven by conviction or by urgency. Finally, positioning and open interest. When markets move sharply, it's critical to understand whether exposure is being added or removed. Changes in open interest can help distinguish between fresh directional bets and liquidation-driven moves. Together, these indicators form a process. None of them provide certainty, but taken as a whole, they help separate noise from meaningful shifts in market structure. Large price moves are uncomfortable, but they are not unusual. What determines outcomes over time is not the ability to avoid volatility, but the ability to respond to it with discipline. Periods like this test assumptions. They force investors to confront time horizon, risk tolerance, and position size. That process is not a failure of the market. It's part of how markets function. The most important takeaway is not whether prices rebound quickly or move sideways for longer. It's whether decisions are made deliberately based on evidence and probabilities, rather than on urgency or emotion. This isn't investment advice, it's simply how I'm reading the market right now. Risk management, patience, and respect for uncertainty matter more than any single forecast. Over the long run, those are the traits that tend to matter most.